I'm Ray Stendall with Stendall Realty Group, and today I want to talk about something most people in Southern California real estate are sleeping on. Not mortgage rates, not inventory, insurance. Here's the number that should be getting more attention. California home insurance costs are already up 16.1% since 2023, according to Insurify's 2026 Insuring the American Homeowner report. Insurify projects another 16% increase by year-end 2026. Stack those together, and you're looking at roughly 34% cumulative in 3 years. That is not a line item adjustment. That is a structural shift in what it costs to own property in this state. And it's showing up in my transaction pipeline in ways that weren't happening 2 years ago. Let me walk you through what the actual filings show, because this isn't speculation. State Farm, California's largest home insurer with about 20% market share, settled in March 2026 for a 17% rate increase. That followed a 17% emergency increase that already cleared in May 2025. Their original emergency request was 22%. The 17% outcome reflects real regulatory pushback, but it's still cleared. Mercury General received approval for a 12% increase effective late March 2026, affecting roughly 579,000 policyholders across homeowners, condo, and dwelling policies. And then there's the California Fair Plan. The state's insurer of last resort filed for a 35.8% average rate increase starting April 1st, 2026. That would be the largest hike in at least 7 years. About half of Fair Plan customers could see increases between 40% and 55%. Now let me explain why the Fair Plan situation matters, even if you're not on it. The Fair Plan is the coverage pool for homeowners who can't get private insurance. It only covers fire damage. Most people on it also carry a second policy for liability and everything else. The average combined cost is already around $3,200 per year, more than double a standard private policy. Since 2018, the number of Fair Plan policyholders has grown from roughly 140,000 to over 590,000. Total Fair Plan exposure reached $750 billion as of March 2026, up 242% from September 2022. That is not a side market problem. That is the marginal pricing mechanism for hard-to-insure California risk, and it is under serious balance sheet stress. Here's how this plays out differently depending on where your property sits. I use a 3-zone framework across San Diego, Orange, and Riverside counties. The first zone I call the kill zone. Markets like Temecula Hills, Fallbrook, Ramona, Julian adjacent communities, and portions of Coto de Caza and Trabuco Canyon. Private carriers are actively non-renewing policies in these areas. The Fair Plan is becoming the primary option. Annual insurance on a $1.5 million property can exceed $15,000 with no ceiling in sight. Buyers are factoring insurance quotes into their offers the same way they calculate property taxes. For sellers in these markets, the carrying cost math is shifting faster than your comps reflect. The second zone is what I call the Battleground: Escondido, Vista, San Marcos, parts of Laguna Niguel, and Mission Viejo. Private coverage is still available here, but the field of carriers willing to write new policies is thinning. Renewal notices are arriving with increases homeowners weren't modeling. In several recent listings I've handled in the Escondido area, insurance conversations started in week 1, not as a due diligence afterthought, as a deal qualifier from day 1. The third zone I call the Citadel: Carlsbad, Encinitas, Del Mar, La Jolla, Coronado, Newport Beach, Newport Coast, Laguna Beach. Coastal properties with lower wildfire risk scores that remain broadly insurable in the private market. These communities are gaining a structural advantage that wasn't visible 3 years ago. When insurance reprices the map, demand concentrates where buyers can actually underwrite with conviction. And in coastal Southern California, that's where supply was already scarce. That combination compounds. Here's the contrarian read I don't hear many brokers saying out loud. This crisis is not uniformly bad for all of Southern California. What insurance repricing is doing, structurally, is sorting the market by insurability. Coastal low-risk markets are gaining a durable tailwind. Inland and hillside markets are absorbing growing headwinds. For sellers in kill zone and battleground markets sitting on legacy equity, pay attention to trajectory, not just today's comps. Insurance is a carrying cost problem in 2026. If the risk model doesn't structurally change, and there's no short-term reason to expect it will, it starts becoming a valuation problem by 2028. The price gap between insurable and difficult to insure properties is widening. That gap doesn't typically reverse. So what do you do with this right now? Before your next renewal arrives, do 3 things. First, request your home's wildfire risk score from your current carrier. Know where you stand before they tell you. Second, document any hardening improvements you've made, defensible space, ember-resistant vents, Class A roofing. Mitigation discounts of up to 15% are available, but you have to ask and provide documentation. Third, compare the private market before you accept the renewal. Don't let the fair plan be your default without shopping first. And if you're selling in a higher risk market, put the insurance picture in your disclosure package before a buyer's lender asks the question. This belongs in week 1, not week 3. I've written a full breakdown covering all of this at the link below. Every zone, every carrier filing, what the fair plan stress actually means, and what sellers need to have ready before listing. If you want to talk through what any of this means for your specific property, call me directly at 858-877-0484. I'm Ray Stendall with Stendall Realty Group. This is the top 1% approach to knowing what's actually moving the market before it moves you.